Hello people, today we are going to learn about plant and intangible asset and straight line depreciation method. So let's get started. What are plant asset? Long-lived asset acquired for use in business operations are plant asset, similar to long-term prepaid expenses. The cost of plant asset is the advance purchase of services. As years pass, the services are used and the cost is transferred to depreciation expense. Major categories of plant asset: tangible plant asset, intangible plant assets, and natural resources. Long-term asset having physical substance are tangible plant asset. For example, land, building, equipments, furniture, and fixtures are all tangible plant asset. What are intangible plant asset? Non-concurrent assets with no physical substance. For example, patents, copyrights, trademarks, franchises, goodwill are all intangible plant assets. Natural resources: sites acquired for extracting valuable resources. For example, oil reserves, timber, and other minerals are all natural resources. Accountable events. The accountable events are acquisition. Whenever a company acquires something, it should be accounted. Allocation of acquisition cost to the expense over the asset's useful life, which is called depreciation, sale or disposal. Acquisition of plant asset. Um, Asset price plus reasonable and necessary cost for getting the asset to the desired location, and reasonable and necessary cost for getting the asset ready for use. This whole thing is called cost. So cost of the plant asset is not only the asset price, plus it also involves the getting the plant asset to the desired location and for getting it ready for use. The entire thing should be considered as a cost. Determining cost example. So let's solve one example to understand more. On May 4th, Heat Corporation, an Ohio maker of stoves, buys a new machine from Texas company. The new machine has price of $52,000 and sales tax was computed at 8%. Heatco pays 500 shipping cost to get the machine to Ohio. After the machine arrives, setup cost of rupees 1,300 are incurred, along with 4,000 cost in testing cost. Compute the cost of company's new machine. So here we will calculate the total cost. So as explained before, it is not the asset price but the total price for getting it ready to for use. So let's see what is there. The cost price, the asset price was 15,000, which is given. Sales tax is 8%, that is 8% plus 8% of 52,000 is, here I have calculated 4,160. Then bringing the asset from the company to the new uh, to the new location is shipping cost is $500, $500 transportation cost, and then it says the setup cost is 1,300. So setup cost is 1,300 and then testing is 4,000. Adding it all together will give you the total cost of total cost to heat company. So for journal entry, we have to include the total cost. So new machine, the asset value is 61,960 and cash as a credit because cash is given to buy this new asset. So cash credit of 61,960. Special consideration: land. Cost includes real estate commission, escrow fees, legal fees, clearing and grading the property. So for buying land, we have to include all these costs for making journal entry. All these costs will be asset value. Land improvement. In case of land improvement, improvement to land such as driveways, fences, landscaping are recorded separately. In case of buildings, repair made prior to the building being put in use are considered part of building cost. In case of equipment, related interest, insurance, and property taxes are treated as expenses of the current period. So in case of equipment, this is slightly different because we have to consider the interest, insurance, and the property taxes, which are treated as expenses for the current period. Allocation of lump sum purchases. The total, if a person is buying a bundle, like buying a barn with the land and animals, etc., the total cost must be allocated to separate accounts for each asset. Each asset, even if the bundle is sold in a whole, the separate asset account should be considered for writing down each of the entry. The allocation is based on the relative fair market value of each asset purchased. Fair market value, remember this. Capital expenditure and revenue expenditure. What is capital expenditure? Any material expenditure that will benefit several accounting periods. To capitalize an expenditure means to charge it to an asset account. Revenue expenditure. Revenue expenditure for ordinary repairs and maintenance. To expense an expenditure means to charge it to the expense account. So for capitalizing an expenditure, we have to charge it on asset account, and for revenue expenditure, we have to charge in the expense account. Depreciation. Depreciation is the allocation of the cost of a plant asset to expense in the period in which services are received from the asset. Cost of plant asset is entered into the balance sheet. Plant and equipment, as the services are received, it is again made. The entry is made in the income statement as the expense, as the depreciation expense here. Once it is purchased, the cost is added as a plant and equipment as an asset side. The total value of purchase, which we calculated before in the previous example, will be used under the asset. And then when it is, as the services is used, as the plant is used, the periodic depreciation expense will be entered in the income statement here under the expense. Book value. Book value is cost accumulated depreciation. Accumulated depreciation is a contra asset account. Represents a portion of an asset's cost that has already been allocated to expense. Causes of depreciation are physical deterioration and obsolescence. So this is very important for our journal entry, so remember this. Straight line depreciation. Depreciation of expense per year is calculated as cost of the asset minus residual value divided by years of useful life. So let's look at an example to understand straight line depreciation. On January 1, 2003, Basco buys a new boat. Basco pays $24,000 for the boat. The boat has an estimated residual value of $3,000 and an estimated useful life of 5 years. Compute depreciation for 2003 using straight line method. So here the cost is $24,000 using the formula which we learned here, cost minus residual value. So cost is 24,000, residual value is 3,000, 24,000 minus 3,000, and useful life mentioned is 5 years, divided by 5, we get 4,200 per year. So using straight line depreciation, in this straight line method, the depreciation per year is $4,200. So let's see how we can do journal entry. Basco will record 4,200 depreciation each year for 5 years. Total depreciation over the estimated useful life of the boat is here. For 2003, the depreciation expense on the debit side is 4,200, and accumulated depreciation, which is a contra asset account, has a credit balance of 4,200. So accumulated depreciation is the total balance of the depreciation we have accumulated so far. So on the first year we will have 4,200 balance. Since the book value given is 24,000, and the equipment has depreciated to by the amount of 4,200, we will deduct 4,200 from the book value, and we'll get the undepreciated balance of the asset, which is $19,800 by the end of 2003. Then in 2004, again the depreciated value is 4,200, and the accumulated depreciation is also 4,200, and the accumulated depreciation balance is the total of the past 2 years, which is 8,400, which again we will deduct 4,200 from the 19,800, which was the balance at the end of 2003. At the end of 2004 we will get this balance. Similarly, accumulated balance is total of past 3 years, which is 12,600. We'll again deduct it from the balance of undepreciated balance, and we'll get 11,400. Similarly, we'll do for each year. We'll deduct from the book value, and we'll get the final salvage value, which is $3,000. At the end of 2007, the salvage value is 3,000. Depreciation for fractional period. When an asset is acquired during the year, depreciation in the year of acquisition must be prorated. Half-year convention. In the year of acquisition, record 6 months of depreciation as half. So let's see example of half-year convention. Using the half-year convention, calculate the straight line depreciation on December 31st, 2001 for equipment purchased in 2003. The equipment cost 75,000, has a useful life of 10 years, and estimated salvage value of 5,000. So we know the formula for depreciation is equal to the book value minus the salvage value divided by total number of years. So 75,000 minus 5,000 divided by total number of years, which is 10, gives us 7,000 for full year. So for using the half year convention, we'll just multiply it by 1 by 2, which will give us 3,500 as the straight line depreciation for the half year. So guys, I hope you got some idea on straight line depreciation. Subscribe to my channel for more on accounting and other things. And thanks for watching.